On behalf of Tulane University's A.B. Freeman School of Business and the Burkenroad Reports, welcome. Join us on an analyst's voyage as we examine SEACOR Holdings, a diversified holding company focused on marine transportation within the oil and gas services industry. Our team of analysts includes Sergio Baine, John Bassar, Juan Figueroa, myself, Marshall Wadley, and we have had the pleasure of continuing Burkenroad's coverage of SEACOR since January of this year. After months of research and analysis, our team has issued a market perform rating for the company and a 12-month target stock price of $67. Today we will be presenting the investment community with the results of our analysis. We will begin by discussing SEACOR in detail, including an analysis of the industries in which it operates and the community's peers. Next, we will discuss the research and calculations that influenced our investment thesis. Finally, we will discuss our method of valuation, as well as the financial projections for the company. SEACOR's story began in 1989 when Mr. Charles Fabricant purchased NICOR along with all of its assets. Beginning as a small oil and gas service company, SEACOR has since expanded its operations into many aspects of the marine transportation industry and has become a consolidated holdings company with a market cap of over $1.1 billion. Affectionately nicknamed the Buffett of boats, Mr. Fabricant has remained at the helm of the company and currently resides as CEO and executive chairman. The company is based out of Fort Lauderdale, Florida. SEACOR operates domestically in 17 different states and internationally in over 20 different countries. Although one unified organization, the company currently operates 5 main business segments. SEACOR's 3 main business segments, offshore marine services, inland river services, and shipping services, are all included in the marine transportation industry. In recent years, the company has also developed and expanded its operations in the corn processing industry. The final business segment of the company, labeled as Other, refers to all of the remaining operations within the business. Offshore Marine Services has historically been the primary business unit of the company. Accounting for an average of 35% of annual revenues, Offshore Marine Services is the segment most often associated with the SEACOR brand. This segment's fleet of nearly 200 boats operates both domestically and internationally. However, the majority of its operations are focused in the Gulf of Mexico. Inland River Services, SEACOR's second largest segment, focuses on providing river transportation for the agriculture industry. This segment's fleet consists of over 1,500 barges, the majority of which are dry cargo barges. The fleet operates along the Mississippi, Magdalena, and Paraná-Paraguay river systems. Although a seasonal industry itself, Inland River Services provides SEACOR with a buffer against the large cyclical movements of the oil and gas industry. SEACOR's shipping services focuses on the transportation of oil and gas and providing harbor towing and bunkering services. Branding itself as a marine transportation solutions provider, this business segment is also involved in LNG support and other marine transportation logistical services. This segment focuses its operations both domestically and in the Caribbean. SEACOR is the majority owner of Illinois Corn Processing, which comprises of the company's 4th business segment. Although far different than its marine transportation segments, SEACOR has successfully operated Illinois Corn Processing, which has acted as an excellent source of diversification for the company since 2012. The various remaining activities of the company have been grouped together into a segment called Other. This segment includes activities such as commodity trading, investing, and emergency services. Shown are SEACOR's historical revenues by segment from 2012 through 2016. Overall decreases in revenue have been mainly driven by the decline in the offshore marine services segment. In 2016, for the first time in the company's history, shipping services replaced offshore marine services as the primary revenue earning segment. Together, the marine transportation segments, the heart of SEACOR's business, brought in approximately $610 million of revenue, or just under 75% of the company's total. Once investors understand the operations of the company, it is essential to examine the industry in which SEACOR operates. In the marine transportation industry, demand is driven by commodities and global imports and exports. Roughly 80% of the global trade volume is transported by ships. Margins depend on the level of domestic and international production and consumption of commodities, such as oil, LNG, agricultural goods, etc. A huge factor in this industry is the cyclical nature of the oil prices. The threat of new entrants is low, as capital requirements are high and current economic conditions are unfavorable. The bargaining power of buyers is high, as the customers in this industry tend to be large and are responsible for a significant portion of the service company's annual revenues. The threat of substitutes is low, as other transportation methods, including helicopters, are limited in their capacity and ability to access platforms. The bargaining power of suppliers is moderate because although suppliers are limited, the marine transportation companies are often large customers, balancing the power in these relationships. Competitive rivalry can be high, as oversupply of vessels forces companies to compete on price. However, many companies have developed niches, which reduces overall competition. Overall industry favorability is moderate. However, for strong established players, such as SEACOR, many of the challenges of the industry can be overcome. Maintaining a positive reputation, strong relationships, and financial health gives SEACOR a favorable position in the industry today. Because of its diversified operations, the company has no true peer group. However, companies such as Hornbeck, TK Offshore, Tidewater, and Gulfmark closely resemble SEACOR's Offshore Marine Services division. Despite operating in the same industry, vessel specialization has allowed each of these companies to create its own niche. As a result, these companies do not often compete directly, and most have their own established customer bases. All of these peer firms are currently under financial distress, especially Hornbeck and Gulfmark. The current economic climate has created a trend of downsizing and consolidation amongst peers. This pattern is likely to continue as long as oil prices remain depressed, and the companies that are able to survive this consolidation will find themselves in a much smaller peer group when the industry again stabilizes. Taking these many factors into consideration, we have established 4 key themes as the foundation of our investment thesis, each of which has shaped our analysis and guided our final financial projections. As is evident by the annual business segment revenue breakdown, SEACOR's recent decline in profitability is a direct result of the operations of SEACOR Marine. The company's other business segments cannot grow fast enough to match the decline in this segment. Until offshore revenue activity is increased, this segment will continue to suffer, as will the company as a whole. As economic conditions lead to continual consolidation in the industry, companies under financial distress will continue to sell off stagnant assets. This will allow financially stronger institutions, such as SEACOR, to continue acquiring vessels as investments at bargain prices. For these companies, offering a suite of services to customers is essential, and a strong diversified fleet is crucial. As a result, customers typically remain loyal to their suppliers, and established relationships remain a dominant factor in determining market share within the industry. Many of the firms within the industry are struggling because of their dependence upon oil and gas companies. SEACOR has been able to remain stable as a result of its diversified operations. Sustaining this diversification will be an essential factor in determining SEACOR's future success. Applying these assumptions to SEACOR's historical financials and industry projections, we have calculated financial projections for the next 2 years. The resulting 12-month stock price estimate for the company is $67. After establishing a number of significant contributing factors, we used a multiple regression method to estimate future revenues for SEACOR. Each business segment was forecasted separately, as the operations for each are driven by different factors. Using a combination of historical averages and industry projections, we established conservative cost projections. Our earnings and share price estimates were driven by these two factors. It is important to note that our forecast assumes a moderate turnaround in oil prices by the end of 2018. As SEACOR's projected cash flows over the next few years are negative, a discounted cash flows method of valuation would be useless. Instead, we used a comparable multiples method to value the company. Using an average of SEACOR's historical ratios, we equally weighted the price-to-book ratio and the enterprise value to sales ratio to establish an average target price of $66.71 for the company. Two additional analysts cover SEACOR, and their 2017 earnings per share, revenue, and price estimates are shown below. Our 12-month price target falls comfortably in between the price estimates of the other analysts. While we have confidence in our projections, the similarities between our estimates and those of the other analysts add to the validity of our financial model. After considering all of our research and financial projections, the Burkenroad Report analyst team gives SEACOR a final stock rating of market perform with a target price of $67. Although the conditions in the industry are still bleak, SEACOR remains financially poised, while many of its peers will continue to struggle. The company should remain at the forefront of the industry's consolidation and remain a diversified and sustainable organization in the near future. Tulane University wishes to remind you that the Burkenroad Reports are produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.